Donald Trump just announced an extension of the ceasefire agreement with Iran, and within minutes of that announcement, financial markets around the world began moving in ways that told a very clear story about what institutional investors think this means for the global economy. Stock markets surged. Oil prices pulled back from their recent highs. Defense sector stocks gave up some of their recent gains, while travel, aviation, and energy-dependent industries moved sharply upward. The market reaction was immediate, significant, and entirely consistent with what experienced traders expected would happen the moment geopolitical tension in one of the world's most strategically important regions showed signs of easing. But if you are looking at those green numbers on your screen right now and thinking that the hard part is over and smooth waters lie ahead, you are reading only the first paragraph of a much longer and considerably more complicated story. To understand what this ceasefire extension actually means for your money, you first need to understand the context in which it is happening. The relationship between the United States and Iran sits at the intersection of some of the most powerful forces in global finance. Iran controls a significant portion of the world's proven oil reserves and sits alongside the Strait of Hormuz, through which approximately 20% of all globally traded oil passes every single day. Any military escalation between the United States and Iran carries the immediate threat of disruption to that flow, which is why oil prices spike and global markets fall every time tensions in the region intensify, and any easing of those tensions, like the ceasefire extension announced today, produces the opposite reaction, the one you are seeing in the markets right now. But here is what the market surge is not telling you, and what you genuinely need to understand before you make any investment decision based on today's news. A ceasefire extension is not a peace agreement. It is not a resolution of the underlying disputes that have kept the United States and Iran in a state of hostile confrontation for decades. It is a pause, a temporary agreement to stop active escalation while negotiations continue, while both sides assess their positions, and while the international community attempts to construct a more durable framework for managing the relationship between these two countries. Every ceasefire in history has had an expiration date, and the question that matters most for investors is not whether this one was extended today, but what happens when the next deadline arrives, and whether the conditions for a genuine and lasting agreement are actually being built during the window that this extension provides. The oil market is where the most direct financial implications of this story are playing out, and it deserves careful attention from anyone whose investments have any exposure to energy prices. The ceasefire extension removes some of the immediate risk premium that had been built into oil prices over recent weeks as tensions escalated. That risk premium unwinding is exactly what you are seeing in the oil price pullback today. But the structural factors that were driving oil prices before the Iran tensions escalated have not changed. Global demand remains robust. Supply from major producing nations remains constrained by existing agreements. The longer-term outlook for energy prices is being shaped by forces that have nothing to do with what happens in any single diplomatic negotiation, and investors who reduce their energy exposure dramatically based purely on today's ceasefire news may find themselves underpositioned when those structural factors reassert themselves. The stock market surge deserves an equally nuanced interpretation. When markets rise sharply on geopolitical news, the initial move is almost always an overreaction driven by relief, rather than a careful recalculation of fundamental value. Professional investors know this, and many of them use the surge as an opportunity to reduce risk rather than to increase it, selling into the excitement, while retail investors are buying on the headline. This does not mean the rally is fake or that it will immediately reverse. It means that the most sophisticated money in the market is frequently moving in the opposite direction to the headline reaction, and understanding that dynamic is one of the most valuable things any investor can know about how markets actually function in the real world. What does this mean practically for the decisions you are facing right now? If you have been holding defensive positions, cash, or reduced equity exposure because of concerns about the Iran situation, today's news gives you the opportunity to reassess that positioning thoughtfully. The ceasefire extension genuinely reduces the probability of an immediate military escalation that would send markets sharply lower and oil prices sharply higher. That is a real and meaningful change in the risk environment, and it is reasonable to adjust your portfolio to reflect it. But adjusting thoughtfully is very different from chasing the surge with new capital at elevated prices, driven by relief rather than fundamental value. The investors who will look back on this moment most favorably are not the ones who moved fastest in response to the headline. They are the ones who use the clarity of a calmer, geopolitical environment to review their overall portfolio construction, to ensure they are positioned appropriately for the range of outcomes that remain possible as the ceasefire negotiations continue, and to identify the specific sectors and assets that benefit most sustainably from a genuine reduction in Middle East tensions rather than simply buying whatever went up the most in the first hour after the announcement. The ceasefire extension is genuinely good news. Markets are right to respond positively to a reduction in the probability of a major regional conflict that would have severe consequences for energy prices, global trade, and financial markets everywhere. But good news in the short term and good investment decisions are not the same thing, and the distance between those two ideas is exactly where thoughtful investors build their edge over the ones who simply follow the headline in whatever direction it points on any given day.